Welcome to today's FX Aggregators webinar, and thank you for joining and registering us today. My name is Candice Dott, and I will be the panel moderator for today. On behalf of Refinitiv, we are proud to host a panel in partnership with Euronext, CBOE, and the LSEG FX venue heads today. Before we start, I will quickly take you through some housekeeping rules and updates. We will have questions and answers at the end of the webinar, so please do post your questions using the question mark widget and ensure that those questions come through throughout the presentation. We will be making time at the end of the webinar for your questions. If you encounter any technical issues, please also submit technical queries using the same question mark feature. If you're having any browser issues as well, please refresh the browser that you're using. Occasionally that helps enable the media quality and sound should you be encountering any challenges. As I mentioned at the start, my name is Candice Dott, and I head up our global sales, strategy, and execution team for our trading and banking business at Refinitiv. Today I'm joined by an esteemed group of panelists, starting with Bart Joris, who joins us from Refinitiv's FX sell-side trading proposition team. He heads that up, and he is globally responsible for Refinitiv's FX trading, conversational dealing, electronic trading, and post-trade workflow solutions as they pertain to the sell-side trading business. Prior to joining Refinitiv, Bart worked for ING Bank, where he led their electronic trading offering from concept to global implementation across asset classes, and he is based in London. Second, I'd like to introduce Paul Clark. Paul heads up our FX venues in the capital markets business of the London Stock Exchange Group. He has worked in the FX markets for more than 25 years, and he is based in London. Next is Trent Beecroft. Trent is the Director of FX and Market Data Sales, covering the Asia-Pacific region at Euronext. Trent has spent more than 25 years in the FX and interest rate trading and sales environment and has worked in various senior roles across Asia. Prior to joining Euronext Markets, previously called Fast Match, in February 2017, he was the regional head of sales for CBOE FX, previously called Hotspot, a position he held for over 8 years. He is based in Singapore. Next is Rahul Bowery, who is the Director of FX and Market Data Sales, covering the Asia-Pacific region of CBOE Global Markets. Rahul has spent nearly 16 years in foreign exchange, with 14 years spent in Singapore, where he has held senior client positions in the industry. Prior to joining CBOE, Rahul was head of FX sales and business development at MarketServe, and prior to that, he worked in prime brokerage and relationship management roles across Asia. He is also based in Singapore. On today's webinar, we will be looking at our partnership across the LSEG capital markets business, Euronext and CBOE, and we will be discussing the importance of liquidity in the market, how the electronic trading market is evolving, how to navigate FX fragmented markets and how this relates to venues, and the role of FX aggregators. I'd like to start today's questions with handing over to Bart, who I'm going to ask Bart to help me set the tone for today's webinar. Bart, would you mind explaining to the audience today what Refinitiv means to be open when we refer to access to liquidity with regards to our FX aggregator solution?
Thank you, Candice. I think it's a very good question, and it actually sets the tone why we are actually here in this panel, and also why it seems a little bit awkward with having a lot of our own venues plus actually competitors to a certain extent where we actually sit into it. But as we all know, Refinitiv actually embraces an open culture into the market. This means we try to serve our customers on all their needs, which means it's not only us, but it's actually what is actually available into the market and what they need to make sure that they get to the necessary tools as well as liquidity in the way how they do operate into the capital markets. We do understand it's not a closed ecosystem, and I think that's the most important piece which actually comes out of it. We all understand it's multifaceted. We all understand that there is fragmentation which actually push liquidity all over, and in order to actually build your whole liquidity pool, you need as well the liquidity into your pool. As well, you need actually tools to make sure that it actually sits into it. So this means also in less obvious places, although for data we are already very known to be open because we carry a lot of data. In analytics we do this. We now also start to do this actually within our own tools which we offer on the sell side or buy side, in the way how we actually bring sophistication to the market and make sure that also the people get to the necessary liquidity to do their day job. As the fragmentation continues and that push for electronification pushes this world even further, you actually see you need tools as well your liquidity to bring it back together, because it's not just access to liquidity, it's actually also the tools how you actually bring it back together and execute in that market. So we launched our aggregator project as a result out of it, and I think it comes part of the trading desktop. We all know we are very strong in our desktop business and where a lot of people are depending on to it. So we actually brought it as well, our aggregator, as part of it to make sure that people can actually use our desktop in the best ways possible, in the best way how we can actually provide liquidity to it. To come back actually here where we sit, and I think in the liquidity aspect of what we want to discuss in this webinar, I think it's very understandable that we as Refinitiv also understand that the fragmentation actually pushed us into that open culture and actually really work from there. So hence, we are now sitting on the table with our partners, which are Euronext and CBOE as a start, but we do have others potentially coming up, or we are actually even having some exchanges joining in terms of isolated markets where it actually sits into it, to make sure we can serve our full client base and actually work into it. In that perspective, I think we need to admit that not all liquidity is the same. And I think that's one of the biggest key questions which actually sits in there. How do we actually make the right mix of your liquidity pool? How do you actually really get your balance right in the way how you work will actually result in the crucial fact of how you actually optimize your executions. I think this is the interesting question which comes into it. And together with our partners from CBOE and Euronext FX, we will actually explore this in this discussion. Now, a few more words which I wanted to make sure that everybody understands. Our aggregator project and the way how we actually talk here is focused at this moment around spot, but naturally we will roll over into NDFs going forward, as well the forward and swap business, which we actually will launch in that same structure and move forward into the market. So I think we embarked here on a very interesting project in the way how we actually move forward. And I would like to actually hand it over to actually the panel and actually have a decent discussion around the liquidity and how they actually aggregate together, as well how complementary some of the aspects are. Thank you, Candice. You're on mute.
Thanks very much, Bart. Really helpful, and thanks for helping set the tone. I'm going to start off with focusing on the importance of liquidity. And really looking at how do we combine liquidity in the right way so as to avoid duplicate liquidity. I'm going to start off by asking Paul Clark if you wouldn't mind covering what it means to provide primary market liquidity from the London Stock Exchange Group capital markets venues, please, Paul.
Sure, thanks, Candice. I hope you can hear me. Yeah, so first of all, a quick background in terms of how we think about and how we perceive running the venue. Obviously, we're here because we're talking about fragmentation in the market, but our clients still see the primary markets as a critical source of liquidity and price discovery and reference. They like the fact that the all-to-all firm-only nature of matching means they can trust the prices they see. They know they can execute when they need to, and they know that they see good interest to trade there. What we've seen over a number of years is an increase in the amount of API trading that happens, particularly on our more liquid pairs. And a good proportion of that is through algorithms, but also a good proportion of it is through aggregators that our clients have been building for a number of years now. But we still see a lot of volume done, particularly in some of the less liquid pairs and regional pairs done by manual users. And there's a big community of clients that trade manually as well as through an API still on the platform. In terms of why people trade on the primary market, we see clients trading for a number of reasons, and it varies across currency pair, and it varies across their trading strategy and style. So we see people trading because they've got passive interest or inventory to manage, because they're hedging client flow. They may have algo strategies, and obviously some clients still able to do levels of position taking, although that's not as much as it used to be years ago. In terms of how we support and operate the venues, we really see our role as making sure that we create an environment for those many different types of participants to execute. So looking closely and monitoring carefully things like the granularity that we display for the currency pairs, the minimum quote life, the speed of market data. We executed things like a randomization mechanism a few years ago to make sure that there was a level of speed that clients had to be competitive, but they didn't need to be faster. So we really see the role of operating the venue as one of making sure that we optimize the system so that all clients can trade in an effective way. And one of the things that we've observed is obviously we've speeded up market data enormously over the last few years, and we've been careful to monitor what does that mean for manual clients and their fill ratios. And generally, we've seen that the experience has got better and fill ratios haven't been impacted. So, but that's obviously something that we're always really, really careful at to monitor. Okay.
Thanks very much, Paul. Thanks. Trent, I'm going to hand over to you. If you wouldn't mind sharing some insights into the liquidity provided from the Euronext FX venues, please.
Sure. Thanks, Candice, and thanks, Refinitiv, for the invitation today to speak. So I thought I might take this opportunity, obviously being an ECN, we're not a primary market such as Refinitiv, so for some people we may not be as well known, certainly not as well known as Refinitiv. Euronext FX operates under our parent company, Euronext NV, which is a pan-European exchange. They purchased Euronext FX some 3 years ago, to diversify their product offering. And within that time period, Euronext FX has continued to grow. So we currently offer 4 matching engines globally, that being New York, London, Tokyo, and more recently, Singapore. And as an ECN, I guess one of the things that differentiates us a little bit from the primary markets is, whilst we may have some similar clients, our ability to customize liquidity is more applicable. Clients have the ability to come on whether they be makers or takers and really set the tone as to how they want to interact on the platform. These clients can be anything from banks, financial institutions, hedge funds, broker-dealers, etc. But as I said, the real liquidity opportunity for them is how they want to interact with us. It doesn't have to be a specific way. Given the fact that we have 4 matching engines globally and they all operate independently, we have clients who can interact with us in New York only. They may interact with us in New York and Singapore, or even London and Tokyo. So there's a lot of variables around the way the client can work with Euronext FX. The offering at this point is spot and NDFs, which is very applicable to the discussion here today. And as we manage these clients and their customizable, applications, we do that by the fact that we have liquidity teams throughout the globe. So we operate our liquidity management on a 24-hour basis. So we have liquidity teams in New York, in London, and in Singapore. So clients have the ability to call us and make changes to the way they're interacting with the platform on a real-time basis, which is something we like to promote with our clients, and we think our clients certainly appreciate that. But overall, our liquidity offering is different in the way it customizes itself versus the primary venues.
Perfect. Thanks, Trent. And Rahul, I'm going to pose the same question to you. If you could share insights into the liquidity provided from your CBOE FX engines, please, and venues. Thanks.
Absolutely, Candice. Thank you. And firstly, like Trent, just want to say a quick thank you to the Refinitiv team and the London Stock Exchange Group for inviting us to attend this panel. A quick observation, actually. You sent through the registration list yesterday, and there was over 700 registrations. That was unsurprising, given obviously the breadth of the legacy Reuters terminal business. But what was actually very surprising, pleasantly surprising, should I say, was the fact that 2/3 of those reside in APAC. Why that's particularly important is that kind of highlights the sophistication or growth in sophistication of not just clients' knowledge, but infrastructure in the region. So I just thought I'd share that at the start. So just as a way, similar to Trent, as a quick introduction as to who CBOE FX are, formerly known as Hotspot. We're one of the largest anonymous FX trading venues in the market across both FX spot and NDFs. To put that in some sort of perspective, last month our average daily volume on our platform was close to 39 yards ADV. That represents, give or take, 17% of the electronic market that's been published on a monthly basis. Broadly speaking, our clients are institutional in nature, so that ranges from banks that are tier 1 to tier 3, so both global and regional, non-bank market makers and takers, and then broadly speaking, buy-side kind of participants that range from asset managers, hedge funds, both discretionary, systematic, macro in nature, CTAs, prop shops, and large retail brokers. APAC again specific, just one more kind of observation and kind of loops back to that sophistication of Asia. We now have approximately 8 or 9 different distinct countries that are connecting to CBOE FX liquidity in APAC alone. So I think that highlights the sophistication of the open-mindedness, should I say, of the market today versus, I'd say, 3 to 4 years ago. So that's been lucrative for both Trent and myself as we operate in 2 secondary exchanges. Just to your question very quickly, Candice, and we're touching on, the ability to curate liquidity. As Trent mentioned, part of CBOE's DNA is tailoring liquidity. We rely heavily on our 24/5 liquidity management team, who are fundamental to how we operate. Thankfully, that's not my role to do that. But we take a very quantitative approach to how we manage liquidity. The aim of the liquidity management team is to match up market makers and takers together to best suit their execution style and ensure that it's not detrimental to either party. We do that through measuring markout profiles and profit decay, but there will be other parameters that clients seek that may be around fulfillment rates, best price, market impacts, etc. Ultimately, I think the answer to your question, Candice, kind of alludes to just transparent dialogue, having two-way open dialogue between the liquidity provider and the underlying customer. I think that's important. So a few things like understanding how clients are accessing liquidity today. Are we pulled together with other venues? Are we the only ECN? Are you executing in a full amount or a sweepable nature? Are you long-term strategy, short-term? The list goes on. So, to avoid duplication, having open and transparent dialogue, I think, is at the forefront of the majority of that dialogue as well. So I'll stop there. I'm sure there's some other topics I want to touch on.
Brilliant. Thanks very much, Rahul. Really helpful. We're now going to move on to looking at market structure and how this can help provide access to the different pools of liquidity to help navigate the fragmented FX markets. Paul, I'm going to start with you again, and if you could please share an overview of the primary market tools available from the London Stock Exchange Group's capital market venues business to provide structured access to liquidity, please.
Sure, thanks, Candice. So again, to quick repeat of one of the things I said earlier on. One of the things that we see is the amount of fragmentation in the market. varies, and also the point of price reference in the market varies quite significantly by currency pair. One of the things that certainly we observed and market participants have observed is the pairs that had internalization and high levels of fragmentation tend to be the ones that are more liquid and more heavily traded. Certainly they were the priority for the banks. The things that we've done to try to help our clients navigate these things are we provide different data feeds for clients depending on their need. So, for example, our data feeds vary from ultra-fast co-located feeds for clients, and then traditional API-based feeds for clients that want to be located remotely. We've also increased the number of order types. So, for example, icebergs, that particularly in currency pairs that are less liquid, allow clients to place orders where they can make sure that they'll get filled if the market hits that certain level, but they're not necessarily flagging to the whole market that there's a lot to do at that level, and there's parameters that allow clients to drip the view liquidity into those iceberg orders. And they're sorts of orders that we've seen clients use significantly across a number of our pairs. As the other venues do, we also provide stats either in our feeds, but also reports that we can make available for clients on simple things like fill ratios, spreads, the amount of iceberg volume or hidden volume available through the book, and also for clients that are really interested in certain parts of the market structure, we provide statistics on how often, for example, their orders, if they were trying to cancel a price, for example, how successful they were in being able to cancel it if they were being hit by someone sweeping. So there's a number of tools we provide. One of the things that, just to mention, is that we do see that different level of fragmentation. And we see it varies enormously by the pairs on our platform. I just realised I'm out of time, so I'll finish there and hand back to you, Candice.
No, really helpful. Thanks, Paul. And I think you underlined a very specific topic there for me around the importance of data and the analytics that one can garner from the venues, and I think importantly how that data can actually help improve how one executes. I'm going to ask Rahul to also share from his perspective how CBOE market structure works with the audience, please. Thanks very much, Rahul.
Sure. So at CBOE FX, and I'll talk less towards club liquidity, given Paul's also on the call, but we do operate three distinct order books. We have our sweepable order book and our full amount order book, as well as our recently launched club. Talking about the two former, our sweepable order book, it represents approximately 75% of our overall volume today. What we're finding is clients are looking to be more creative with how they execute with liquidity. So whilst we have a lot of aggressive flow flowing through our sweepable stack, we are heavily promoting firm liquidity and passive interaction, where clients are looking more so to receive spread rather than just continuously pay spread for best execution. Being a non-all-to-all market, as I said, we match makers with takers. We do so as well on our full amount platform as well. We operate the largest anonymous full amount order book, which yesterday I think was trading at 11 yards ADV. It's a tiered ladder from 1, 2, 3, 5 out to 100 million. And again, this is another order book that we segregate between our sweepable stack to ensure the correct clients are connected to the correct pools. I think back to the original comment on transparent dialogue, I think it's pertinent that you understand what type of flow is coming through and help guide clients towards the correct order books, but also give them a better understanding in terms of how they should interact with that liquidity. So as an example, full amount liquidity needs to embrace the rules of engagement in quotation marks. And I know everyone has a differing opinion on how that should work, but within best practices, and that can help manage not only your liquidity profiling on our platform, but the quality of your execution as well.
Thanks, Rahul. I think, again, you outline the importance of the quality of execution and really looking at taking the support from the different venues in terms of giving customers the required information to understand how well they're doing and whether there are areas for tweaking what they're doing. Trent, over to you. If you wouldn't mind sharing the perspective of Euronext market structure, please, with the audience.
Sure, Candice. I'll probably take this in a slightly different way than Rahul's spoken about the liquidity and the order types, etc. And one of the things that we've developed, at Euronext over the last year or so is growing our matching engine spread. In that, having launched the SG1 engine in late 2019, has allowed our clients another pool of liquidity. It's also given our clients the ability for price discovery, which is something that is creating this fragmentation in the market. If we look at the Asia market, there is very few exchanges or ECNs with matching engines in this part of the region. And this part of the world, as we all know, is growing at an astronomical rate as far as markets, whether they be OTC or exchange. So our view here at Euronext is in putting a matching engine into Singapore, it gives our clients the ability to access the liquidity that may not suit their style, if it be in New York or in London. It obviously also cuts down on the latency issue dramatically as well. But certainly price discovery for us is a very, very big issue. It's something I feel really passionately about in regards to Asia. We know there are some platforms that are stepping away from this part of the world. I think that's a big mistake because I think given the growth economically in the region, I really feel that over the next few years we're going to see huge growth in not only currency pairs and the volumes, but in the products that are derived from those currency pairs. So for us, as far as, giving clients pools of liquidity, it's more about giving them a geographical breadth and knowing that, accessing the liquidity pool in Singapore would be maybe much more closer to home to their style of trading. And as I said, our clients can be varied very much from, the top 20 banks in the world to small local broker dealers who, may see themselves get lost in the bigger scheme of things. But if they're matching here locally in Singapore, it's a much more closer to home experience, and I think something that they'll appreciate in the long term.
Trent, it was super helpful, and thank you for outlining the regionality importance. I think importantly to today's audience, we know that we've got a heavy presentation of people in the Asia region. So thanks for bringing the localness into this. I think for Bart, if you wouldn't mind sharing some specific examples of work that we've done in Russia and Brazil, where we've been able to help solve for regional market liquidity access requirements for the audience, please.
Sure. Thanks, Candice. So I want to pick in here because I think, indeed, when you actually divide the world up into different parts in how liquidity works, I think you can have the big worlds of actually what we call the ECNs, where we actually really work into. On the other hand, you actually have something what we call the relationship trading model, which is actually driven by relationship and not actually the more anonymous worlds where you actually all are not matched as explained by the panel. But I think there is a third world which actually sits into it, which is exchanges. Due to credit, due to the way how the market faceted in the past, you could actually see that you have exchanges which are driving actually the FX market. One of them is, for example, MOEX for the ruble liquidity, which is enormous and actually drives that pool. The same we see actually in Brazil with Bovespa B3, which is actually doing the same thing. But also closer to Asia, we actually have, like in Taiwan, which is one of the biggest exchanges for actually the Taiwan dollar. So I think what we try to bring is we have a multi-cultural, multi-regional, multi-way how we actually operate as Refinitiv in our public. So we need to make sure that we actually cover every needs. And that's what we actually really try to resolve, bringing the liquidity which is available to the people through our ways, the way how we work with it, and then also offer the tools, because not every liquidity pool can be accessed in the same way. When we know, for example, if you take an exchange, for example, and if it's a pure future, we translate it, we bring it back into FX terms, so you can actually trade it as FX, and then in the back end, you actually get the future against it. You can even swap it out, or you can have cash futures. We try to, with the technology which actually comes along with it, with the liquidity pool which we actually bring, we bring the right tools along with it to make sure that you can actually cover your liquidity where you want to access and what you want to access at any time. Maybe one of those pieces, and it's regional as well to a certain extent, is not every pool is at any moment in time the same, which means we all know when the market starts to go heavily moving, relationship trading starts to, spreads are going up, so at that moment you actually need to actually have other liquidity pools to your hands, or you're actually going to start to pay too much spread into it. Like Rahul was already mentioning and Trent was mentioning, why would you actually always be very aggressive into it? So I think that's a topic which comes into it. Why would you pay the spread if you actually now suddenly have the tools? Why would you be very aggressive into it? So I think that part of that whole discussion is very important, which liquidity pool you have at your hands at which moment in time. And you need to have actually the full suite before you cover for every moment in time. And is it now the regional aspect or it is the difference in liquidity? I think it's as important the way how you actually constitute and build up your liquidity pools to your availability. Thank you, Candice.
Thanks, Bart. Thanks very much. So looking at the future of liquidity, I think we might need to go on mute. Thanks very much. Looking at the future of liquidity, I'm sure that the audience would like to hear from our panelists and specifically understand more on what that means. So looking at starting with Trent this time, if I could please ask you to highlight any regional trends to get ahead of, specific things that might be adding value to the industry, anything helpful from an initiatives that you are focusing on to enhance liquidity or the venues moving forward, that also could underpin the plans to help manage fragmentation, areas that you're busy working on, any of those specific topics. If you could share those with the audience, please.
Thanks, Candice. Yeah, there's a lot to unravel here. I think electronification of the markets is a given, and it just continues to accelerate at an accelerating pace. And with that electronification becomes, easier access for clients. We're looking at markets in Asia that, 5-10 years ago, very restrictive, limited capacity for any electronification. But, we've seen this dramatic reduction in cost. And as I said, the accessibility to tools to do this means that clients have access to better, faster, sharper markets. So certainly what electronification brings to us, it means there'll be greater customization for clients. I think that's another big thing that we'll see in the years to come and the months to come. It's not just going to be one price fits all. I think you will see more clients look at how the way they want to execute their transactions. They'll be more selective about how they do it. I think there's a better understanding now on both sides, whether it be market makers or market takers, such things as slippage, price leakage, all these sort of things are becoming very, very transparent. So once the market gets more comfortable with the transparency, I think you'll see a lot more products coming to the front, as well as more customization around one-on-one trading with certain parties. So lots of exciting things on the electronic side. The other piece is, I do think over time, and we're already starting to see it, that the culmination or somewhat the merger with the OTC and the exchange model, it won't be a full merger to say, but I do think we're drawing closer. As Bart mentioned, talking about the futures and the spot market and how that develops for clients. I do think we're going to see a lot more of that, especially in the Asia region. I think a number of the exchanges in this part of the world are very keen to look at expanding their non-equity business, which incorporates futures, and some of the exchanges have already taken on platforms on the OTC as well. So I think there's a lot of development to happen around the exchange and the OTC space. And then on the back of this, a lot of this comes from the developments in the NDF market. We launched our NDF product at the end of last year. We see huge potential in that product in this Asia region, and that's another reason for us putting the Singapore engine in place and getting our licensing from the MAS here. We're a recognised market operator, allows us to trade NDFs out of our Singapore engine. One of the points of note is that Asian NDFs, 90% of the volume is executed before 6 p.m. Singapore time. So for a lot of people who are sitting here in Asia, they want to get their trades and their business done during this time zone. So I think you'll see a lot more of that. And as I said, with more people having access to markets, having access to electronification, there'll be a lot more demands from the clients. And I think for us as providers, that means we've got to work even harder. We've got to, because the demands are multiple demands. It's not just a simple product, spot product to deliver anymore. Clients want a lot, and they want to be executed at extremely competitive pricing. So there's a huge onus upon the platforms to provide better and better service to clients going forward. So a lot of exciting stuff. And as I said, I think a lot of this stuff, a lot of the products, a lot of the development will come out of the Asian market just because the client demand is so strong here.
Thanks, Trent. A really helpful perspective. If I could ask Rahul for you to share some of your regional perspectives.
Sure, and I'll try not to overlap with Trent too much because observations are pretty similar. But in line with what Trent said too, very real and present observations are, in no particular order, NDFs and the local matching engine. I think most people on the call are interested to hear about that. NDFs has been a slower mover than we've all expected, contingent on a few things. I think there were certain institutions that weren't ready to auto risk manage their NDF business. There's a bit of a push and pull going on at various institutions, but as that has now moved forward, we are seeing huge progress within the NDF electronification market. I think listening to clients and evolving the NDF product further, increasing, as an example, the different tenors that are available on a streaming basis, because it's very difficult to do that on a broken basis on an anonymous platform, as well as obviously listening to clients in terms of the offsets with the futures market, so the SGX offset on the NDF exchanges or the local markets as well themselves. As well as full amount. We're looking to replicate on our NDF platform the success from our full amount business as well. Naturally, NDFs are traded in larger sizes and are less latency sensitive. So that segues nicely into the SG1 dialogue, which we're very much part of and have been engaged with the MAS for some time. It's a very real conversation. We can definitely see the advantages of being here, and clients are definitely knocking on our door. I think we're very much in a position today is in terms of how long is a piece of string. I think there is people still deploying infrastructure in SG1, and we're listening very closely to our partners to ensure that we're ready to be there when required. I think one notable observation outside of that is really the continuous automation of the sub-asset classes of FX. I think one potential asset class there that's potentially ripe for the taking is FX options. particularly the vanilla calls and puts. There has been noticeable traction of late, particularly in Asia, around FX options and electronification. I think that's a natural sub-asset class that can move away from voice and voice brokers towards electronic platforms as well.
Thanks, Rahul. Really, really helpful. Thanks. Paul, if you wouldn't mind sharing from your perspective what some of the trends are.
Yeah, sure. Just one thing I wanted to just something that Trent said about the OTC and exchanges becoming closer together. I guess it's not lost on any of us that all of us started off in companies specialising in FX and are now part of exchange operators. So one thing, particularly from a regional point of view, I want to mention is that we've been talking today from the LSEG point of view around the primary markets, so matching, but we don't just operate matching. We also operate an ECN, we also operate Price Stream, which is a request for stream product, which we operate out of 3 regions. So we have instances in London, New York and Asia, as well as the traditional FX all product as well. And I think one thing that's clear is the fragmentation in the market and people wanting to have the appropriate way of trading for the way they want to trade at the time is certainly something that's here to continue. We've seen a huge change in the market over the last 10 years. I think risk is much more closely monitored now, and even small exposures that participants take on are hedged quickly. Average trade sizes have come down, and we see these trends all continuing. So I think that from a global point of view, having more granular products, certainly in spot, has gained popularity, and we want to make sure that we can help clients trade and manage risk in more effective ways. As Rahul and Trent have both mentioned, NDFs is clearly a product that has been trading more electronically and is going to continue to grow. And that's an area that we're making investments in. And also in FX swaps, which has been one of the biggest growing parts of the market, but still primarily manually traded. We see huge demand from clients to trade more electronically in the FX swaps market. So again, things we're looking at. The other things that I think are areas of focuses for clients include things like credit. And that's an issue. Obviously, something that's talked a lot about in the market at the moment is the prime broker parents and the challenges they have for managing credit, but also banks and regional banks who are trading across multiple venues and how they manage credit there. So there's certainly things that we want to look at for how to help our clients manage credit as they trade on one or across multiple venues or multiple regions. And obviously for us, it's quite an exciting time where after the acquisition with the stock exchange, there's a lot of planning we're putting in place. Too early to make announcements, but certainly a lot of things that we're thinking about doing in terms of investments we want to make in our venues.
Thanks very much, Paul, and thanks everyone for your perspective. I hope that helped everyone listening today with things to start thinking about if you're not already. I do want to make time for questions at the end. So my final question to our panelists is looking at the role of aggregators and the importance of relationships, execution styles, and the distribution of liquidity. Looking to Bart first, if you wouldn't mind sharing with the audience some of your perspectives, experience at ING, and the importance of relationships and execution styles, and the impact that they had on access to liquidity and execution results. If we can just keep some of these answers short so we can make time for questions. Thanks.
Thanks, Candice. Yes, so let me bring in, because I think working with an aggregator, and I always say the word in itself already introduces some complexity into the whole discussion, because to a certain extent, an aggregator means aggressive. And what you could actually see, and my own experience as well, is a lot of the people which actually first time handled an aggregator, they go on the very aggressive side of what an aggregator actually does. Just hit the price and actually let the aggregator works into it, which is to a certain extent the purpose where it sits into it. But the real value comes in when you actually really understand what that aggregator is actually offering to you. It's not just a smashing tool where you can push liquidity through. It is actually making sure that we actually understand what the liquidity actually is and which liquidity you actually work at which moment in time where you actually push it through. So, and I can give you some nice examples, because aggregators are used within the electronic flow, they are used within the manual flow, they are actually used in every part of possibilities where you actually sit in there. So as a result out of it, the way how you need to set up your aggregator and your liquidity pools needs to match the way how you actually really exercise into it. If you have, for example, a very aggressive flow and you actually would give that continuously into your relationship-based liquidity pool, you would get yourself in trouble, because people will actually start to actually see rejections going up, will see how your spreads are going to widen out and how you actually really work in there. So the combination, and I think as well, all the panelists actually hit on it to a certain extent, the relationship which you actually have with your liquidity providers, how that pool actually sits, that discussion which you need to have with your relationship on the other side who receives your liquidity, is vital in actually understanding how you need to actually trade for the best optimal result where you actually come from. An aggregator is just not just an aggressive tool, to say it like that, although the name to a certain extent actually reveals it this way. It is not just the way how you should work. The same logic which traders were applying in the past before an aggregator, you can still apply them in the same way, and you can electronify those ways of working. And I think that's very important, because we can't step away that it is still a driven market due to credit, due to relationship, and the way how we actually trade into it. In the end, it needs to work for everybody, or it doesn't work for anybody. And I think that's the main important message which I can give around this. And that discussion, and anybody who comes on this, feel welcome. We as Refinitiv more than willing to help you out in there, advise you, and actually really get you up and straight into it, because it's not that straightforward as people think when they get first in touch with an aggregator. Thank you, Candice.
Thanks, Bart. Trent, some of your perspectives, please. If we can just go on mute. Is it echo? Trent, just Euronext perspectives, please, in terms of helping distribute access to liquidity for optimal execution results.
Sure, Candice. I'm aware we're a bit short of time, so I'll make it short and sweet. I agree very much with what Bart said. You know, despite my passion for electronification of these markets and the speed of electronification, at the end of the day, this is still a heavily relationship-driven business. And that's in all facets. That's in liquidity management, that's with sales, that's with operations, that's with, you know, the guys who are building the databases, everything. There's a lot of relationships driven through this market. So one of the things that, you know, when we set up the Singapore engine, it was vital that we continue those global relationships, and that's why we put a liquidity team in place here in Singapore, because that relationship, rather than the client having to wait for London to come in or, you know, get up super early and speak to New York, you know, the client can basically speak to the liquidity management team based here in Singapore real time and make changes to their flow, whether they be a maker or a taker. They can make real-time changes on the fly right there and then. So it's a combination of, you know, electronification combined with old school relationships. And I think that's the way that this business will continue to go forward.
Thanks, Trent. And Rahul, any input from you, please?
Obviously, being similar to business lines to Trent, there's again overlapping points we're going to make. But yeah, you know, just to echo what Trent was saying, as an ECN and as a salesperson within CBOE, I don't go out and look to displace relationship-based trading. It's very much being complementary to what you have. There is obviously, for want of a better phrase, an education process in terms of two-way dialogue around how many liquidity providers is optimal, for sure. And I think everyone has an opinion on that, and everyone also thinks they're right. I don't think there is a correct answer to that. I think it comes down to, again, that open dialogue in terms of what you're trying to achieve in terms of execution. From our perspective, we, just echoing, we try and continue to be transparent around that. From a distribution perspective, that still remains the same. We ensure that, I think, another angle that Trent didn't touch on was around reporting. So, trying to explain to clients why, as an example, month on month, their spreads may have widened, just giving them data and analytics around the quality of their flow and having, again, open discussions around any changes that may have occurred and may have impacted. We provide a report to data to our clients as an example, where if spreads have degraded and markout profiles have also degraded, there's obviously a natural correlation as to why that's occurred. And we see what we can do, whether that be segmentation or adjusting just the way we have dialogue on a more frequent basis to address that.
Thanks, Rahul. And Paul, any input from you, please?
Yeah, not a lot from you, because I think there's a lot that the group have already covered. I completely agree with the comments around, using an aggregator isn't about just sweeping and aggressing liquidity, because that's going to have an impact on liquidity providers and ultimately the liquidity that a participant would then get in the long run. I think one thing thinking about this as well is, over the last few years, there's a huge amount of work that particularly providers have had to do because of the global code. So there's a huge amount of work that providers have had to do in terms of how they manage liquidity, how they provide transparency to participants, how they around how they're providing liquidity, how they're hedging it. And I think, just to almost as an echo in terms of what the other people have said, is I think that the kind of transparency, ideally, to work well in an aggregator needs to go both ways as well. Obviously, there's a push at the moment to make sure that everyone signs the global code anyway. But it's just as important for people that are taking to think about how they're going to use and execute the liquidity that's available to them, as it is for those providers to be open about how they're providing it. So again, I think in an aggregated world, thinking about making sure that participants are thoughtful around how they're integrated, how they're working with the global code is important as well.
Thanks. That's such a critical topic, Paul, and thanks for raising it. I'm going to urge the audience, if you've got any other questions, please post them now. We've got about 7 minutes left for questions. And if we don't get to some of your questions, we will make sure that we answer them as a follow-up to today's webinar. I'm going to ask Bart if you wouldn't mind responding to one of the questions that's come in. With regard to the FX aggregators business as a whole, how we look from a competitor standpoint. So who and what are the main competitors for FX aggregators, and how the FX aggregator could strengthen its value proposition? Also, would the FX markets change when FX aggregation adoption increases?
Oh, that's a lot of questions in one go. So let me try to unravel a little bit the discussions. And I think there are, let's call it like this. If you take a look to the world of aggregators, and you heard this also out of the panel discussion which comes up, you can feel Spot by Excellence is already a product which is actually fully electronified to the maximum it can get at this moment, depending on which currency pairs and regions you are actually talking into. So what aggregators are actually doing is more a result of the fragmentation which came actually into the market with sophistication tools to bring back those views in the way how it actually sits in there. Or the main competitors, of course, I don't think I'm going to mention any of the competitors here, but I think we all know them left or right, and if anybody, I can give them offline without any issue in there. But I think what we are actually focusing on, because the Spot, as it is actually quite what I would call a commoditized world in the way how they work, you can work a lot with liquidity pools. and the way how you actually constitute your liquidity back together and stitch it together. And it will depend from region to region, as we discussed in the panel. I think that's a world which is actually quite well penetrated to the one hand side for technology, which is actually ready to actually embark into that. Will that actually increase, and will it change the liquidity pools which comes into it? Oh yes, 100%. I think it drives a lot of the individual liquidity pools, and to a certain extent it actually drives further the fragmentation which already sits in there, because certainly the tools are available to connect more into it, and the more you connect, the less you want to actually push your footprint into a certain level or make your footprint visible to any of the participants in the market, the more you actually fragment further that market which actually sits into it. The smartness of the aggregator is much more important in there, the way of that how execution. So that real thought of not actually pushing just a VWAP into it or a sweep into the market, which actually reveals totally what you're actually doing into the market. And sometimes it's needed. I'm not going to say it's not a tool which actually shouldn't be there, but the smartness in the way how you execute is actually the differentiator between aggregators. And then the second piece, which I think is very important into it, is the evolution of aggregators, because that market which we were talking about, what is the next electronification? NDFs are already a long time in a position to become more electronified, but still there is some hesitance for all good reasons, and we can touch that it long into it. But I do think that's the next one, which is actually really up for electronification, and where aggregators will jump into for two reasons. Mainly, it is the market which electronifies, and secondly, it is very close to where spot sits. So the tools which actually sits in there are very similar to what they actually at this moment can be applied in spot. Now, there are main differences, and you will see this in the way how we work. But I think, and that's the last piece which I said, that the real revolutionary piece which is going to come in is when we really go on aggregator levels for forward books, because it ties in with something which the panel is, and I don't know who it was actually said, but liquidity drives price discovery. The more price discovery comes in, the more participants will come into that market. And the more price discovery you can do, the more it is actually suitable to actually bring aggregators into it. So it's a vicious circle in the way how we actually push that market. So yes, that's how I see the aggregators. And yes, they do have an influence in the liquidity pools.
Thanks, really comprehensive answer. If you can go on mute. In terms of some of the topics that you raised there, I just want to do a quick shout out to everyone that's on this webinar. On the 27th of April, we will be hosting another webinar, that's next week, specifically discussing how electronification of the FX market has evolved. So I would imagine that we will be uncovering more in relation to Bart's feedback and the evolution of how electronification is changing the market, and specifically areas to focus on. So please register for that webinar. Paul, there was a question for you, specifically asking about trade sizes and a comment that you made about trade sizes getting smaller. Is that because takers of liquidity are focusing more on market impact, or is it due to liquidity discovery by new market participants, for example, retail market participants? Or is it perhaps for a completely different reason altogether?
Yeah, thanks. I think it's for a number of reasons. Certainly, my interpretation of it, I think it's partly because of the fragmentation in the market. I think it's partly because the way that participants are executing is changing. So, I think another thing we mentioned is a lot of participants are either holding on to positions for a shorter amount of time, or they're just hedging positions almost straight away when they get client flow. So rather than building up a position that they then hedge, we certainly see participants hedging it much quicker. So I think it's a combination of the appetite for risk that many participants have. And hedge and hence hedging quicker. It's a combination of the price granularity that people are trading at, and possibly also an impact on the number of the different sorts of participants trading in the and obviously the electronification and the fact that people can trade quicker has also contributed to it. So I think it's a whole combination of things. I would say is the answer to that.
Thanks, Thanks, Paul. Trent, 10-second final input if you feel you've got anything else you'd like to add to today. Rahul, the same for you before I wrap up.
Just to support what Paul said there, I think the electronification has, because people have options with electronification, i.e. avenues to execute, and that's a great thing, but that's probably has something to do with the size of the ticket shrinking. Exciting times ahead, I think. Certainly in the Asian market, there's a lot of growth. The electronification will continue to happen out here. Price discovery is something that's going to be something that needs to be spoken about because Asian markets will continue to need price discovery going forward. Thank you.
Thanks, Trent and Rahul. Last few words from you before I wrap up.
Yeah, absolutely. Look, just thank you for allowing me to attend today. It's just nice to have an opportunity to explain to the wider community in APAC that ECNs aren't also aggregators. There is a new term of aggregator out there, and we can be complementary and sit within that aggregation stack today and provide you value-add services as well from a liquidity provision perspective. But yeah, look, thank you very much.
Brilliant. Thanks very much. I think you summed up the entire webinar, which was all of this is very complementary. I'd like to thank our audience today for spending the past hour with us. I do hope you gained some useful insights into the topics that we covered around liquidity and aggregation. I'd like to thank our panelists again. It's been a pleasure hosting four of you who are all deep domain FX specialists, both across Asia and Europe, and being able to work in partnership with all of you now and going forward. So just for the audience, please note that we will share follow-up feedback. So we would like your feedback, please, so that we can improve these webinars going forward. And in addition, there will be a recording sent so that you can share that with other participants who weren't able to make it today. And lastly, we look forward to seeing you on future webinars. Reminder of the webinar next week that I asked you to register for. And thank you all again and have a pleasant rest of your day. Thanks for joining. Bye-bye.